Okay, hello. I'm Rod Sahasrabudhe with Oliver Wyman, and me and my colleagues Felix Chan and Jalen Reichner are going to be reviewing our 2026 semi-annual industry review and the preliminary findings of that analysis. We have several sections in our review today. We're going to start with the economic indicators, briefly discuss industry benchmarks, review the loss trend benchmarks, and then talk about inflation and the post-COVID new normal that are sections that are contained in our semi-annual review. So just starting with the discussion of economic conditions, because the economy drives the amount of activity, which will, of course, drive claims frequency. So on this slide, we present several metrics related to economic conditions. You'll note that the Alberta unemployment rate has sort of ticked down a little bit from the high in June 2024, but is still above the June 2022 and 23 values. The CPI index, you see there's a slight or a decrease in cost since June 25, and really it's stabilized quite a bit since June 2023, and we'll talk about that when we get to the inflation section as well. There's a little bit there's a little bit less volatility in the CPI that excludes energy. Again, we'll see that the costs have sort of stabilized to after the height of the pandemic. And then finally, we'll see quite a bit of volatility in the gasoline CPI, and most notably, pretty significant decreases between 2024 and 2025 and the latest reading. In terms of the latest readings, most of these readings are as of December, but there are a few of the items that are only available through November. Just to finish out on that, there's a little bit of volatility as well quite a bit of volatility in the natural gas prices and then the Canada benchmark as well. The population, while that was increasing at a pretty steady clip through June of 2025, that rate of increase also seems to have slowed. Here's a chart just showing the long-term unemployment rate, and again we see that the long-term range is sort of between 5 and 7. We had sort of popped out above that range for a little period, but now it seems to be back within that range, though it is in the higher half of that range. And here are the bond yields. Of course, they were depressed during the pandemic, and then came back up as economic activity increased, and have now sort of settled back down into the 2.5% range. Okay, with that, I'm going to just briefly discuss industry benchmarks. These are items that have not changed since our 2025 annual review, so we're not going to spend a significant amount of time on these items. So the primary benchmarks that we include in our report relate to the health cost recovery, also known as the health levy, which is at 1.94% of premiums. That metric is typically released in late January. So what you see here is the metric for 2025, and we expect that the 2026 health levy will be released soon, and we will have that final health levy metric in the final version of the semi-annual review. We also provide operating expense information and profit information as benchmarks for the board's review of rate filings. And with that, I'm going to pass it over to my colleague Felix to discuss the loss trend benchmarks.
Thank you, Rush. So with our 2026 semi-annual review, industry benchmarks, we can see that for most coverages, the trends have remained relatively similar to the prior report. The main deviation from our recent reports is a higher development within the liability coverages, which I will discuss in the following slides. And also another thing, we've continued to use our updated treatment of inflation that we introduced in the prior report, and that's included in this report as well. When we look at the bodily injury loss developments, our severity estimates for 2021 and onwards have increased, with larger increases observed in more recent periods. When we reviewed our data along with the ARB, we identified two insurers that had higher than expected development. We decided to estimate the ultimates for these two insurers separately and the industry excluding these two insurers. Then we recombined the estimates to arrive at our total industry loss estimate that is used in our trend modeling. Here we present a table of the percent change in bodily injury ultimate loss estimates between our prior review and current review for the two insurers, and the industry excluding the two insurers separately by accident half year. We note that the loss estimates for the industry excluding the two insurers have remained relatively stable. Conversely, the ultimate loss estimates for the two insurers have experienced significant changes in the recent accident half years. We will continue to attempt to accurately estimate the industry ultimate losses, but do note that we rely on accurate data reported by insurers to accomplish this. So when we dive into the development factors, the age-to-age development factors, when we look at the industry, the total industry, the industry excluding the two insurers and the two insurers separately, we see that the development factors have slowly risen in the last 20 years for the rest of the industry, while the two insurers had a relatively stable development factor from age 6 to 12 months until the more recent accident years, where we see some volatility creep up into their development factors. Moving on to the age 12 to 18 development factors, we see a similar trend emerge, where the volatility for the two insurers shows up in the more recent accident years. So how that translates into our bodily injury trend estimates is that when we compare our prior report, which is the light blue line, to the current estimates, which is the dark black line, we see that our loss estimates have decreased. And we want to drive home the point of uncertainty in these estimates. We do see a flatter trend emerging, although it is still above the pre-pandemic level. And now I'll have Jalen go over the inflation section.
Actually, I believe I had the inflation section, Felix. So I'll
Sorry.
No, that's quite all right. Jalen, I think that was going to be a surprise for you, right? Anyway, so again, inflation. Again, this is closely related to the discussion in the economic in the section on economic conditions. And then so we're going to talk about what we see in the data and then also how we modeled that for purposes of estimating loss trend. So we're all relatively familiar with the causes of inflation that occurred right after the pandemic. Those are described in some of the bullets on the left-hand side. Uh, but I think what's important now is that we have even more evidence that inflation levels have moderated since beginning in 2023. So what we have is a period of temporary high inflation, and we're in the slides that follow, we're going to discuss how we consider that temporarily higher inflation in our modeling of loss trends. So, and we're going to discuss it sort of separately for the physical damage coverages and the liability coverages, and the CPI measures that we use for those two groupings are going to be different. And for the liability coverages, we look at we review the CPI metrics for healthcare costs, and what we see is that again, if we look at the BI data, that there is a bit of an acceleration during the post-pandemic or in pandemic and post-pandemic period, but it's just slightly lagged and it's not quite as severe as you see, for example, if you were to compare the bodily injury coverage versus property damage or collision. The that rate of increase isn't just quite as apparent, and when it starts, there's just a slight lag. So from here, there's a series of our underlying consumer price index data. The left panels on each of these show the cumulative CPI metric since and the right-hand panels show the year-over-year changes, which is typically what we're more concerned with. So in the all-item CPI, again, you can see the spike during the post-pandemic period and sort of return to 12-month changes that are generally consistent with historical averages. And that's a pattern that we're going to note as we go through the other CPI measures as well. So transportation is one of the measures that we'll look at when we think about the physical damage coverages, as well as the cost to purchase private passenger vehicles, rental costs, and more. The vehicle parts maintenance and repairs, which we think is really one of probably the best metric to look at for the physical damage coverages, and then the cost of healthcare. And again, we see here a situation where there's just a slight lag in the healthcare, the increase on healthcare costs. Again, that if you go back and we'll see sort of how that aligns with the bodily injury trends. We do note that the healthcare year-over-year changes are still just slightly elevated over what we had prior to the pandemic. So those were the underlying CPI measures, and here are the observed severity changes with red dots for all the points that are in excess of 10%. So if we note that for bodily injury, again, just immediately after the pandemic, there were a number of periods that were in excess of 10%, but now have sort of returned to lower levels. Accident benefits sort of similarly, there were a few points that were in excess of 10%, and but now the last 2 points are below that threshold. Again, those were the liability coverages driven more by healthcare costs. And now the physical damage coverages, again, I think here what we see is, again, a similar pattern of a few data points of higher inflation right after the pandemic, but the more recent data points having settled into a range back that's really consistent with pre-pandemic changes. So how do we model this in our data? We use what we refer to as the excess inflation parameter, and that's a parameter that measures excess inflation based on CPI data. So we essentially relate the additional inflation in loss costs to, or I'm sorry, severity to the higher than excess inflation or higher levels of CPI changes. So we look at what sort of the normal level CPI changes were, and then what the higher level was, and then relate that differential to the differential in loss costs and severity trends as well. There's another other measures as well that we have used in the past, the single period or multi-period approach. That aligns with the view that the effect's temporary. That's consistent with the approach with the excess inflation parameter. The primary difference is that under this single period or multi-period scalars, the approach assumes that excess inflation is constant during those periods, whereas the excess inflation parameter doesn't. It sort of aligns with the level of excess inflation that's observed in the CPI. And then there is also an approach with the additional trend parameter, which again just captures higher levels of inflation, but doesn't relate it to an underlying effect. And that while that aligns well with the compounding effect of inflation, it assumes inflation will persist into the future, and that may not be reasonable. And actually, what we're seeing is that probably isn't reasonable as we see inflation return to pre-pandemic levels. On these charts, we show on the left sort of the way we determine the excess inflation. It's the CPI data, again, using the private passenger vehicle parts maintenance and repairs metric. And we'll see sort of the red points are, had the historical inflation continued, where costs would have been. The black points are sort of where costs are, and the red arrows indicate that excess level of inflation. And then on the right-hand side, we present the resulting excess inflation factors that are applicable to each of the accident semesters. And these are factors that would be applied over and above the prevailing trend rates that you see at the top of those columns at plus 8.8 for bodily injury, plus 1.6 for property damage, and plus 2.4% for collision. Future loss trends, again, the idea here is we want to make sure that we are not extrapolating that excess inflation into the future. And so it's just so the past loss trends measure through the midpoint of the data that we've reviewed, and that in this case is going to be April 1st of 2025 for this semi-annual review. Okay, with that, I'm going to pass it over to my colleague Jalen to go through our final section on the combined new normal.
Thanks, Raj. So I will start with a couple of reforms that are affecting the experience period that are included in most rate filings. And the two major reforms are Bill 41, which affects bodily injury and accident benefits, and then the introduction of DCPD, which we'll see seems to have affected both total property damage and collision. So starting with bodily injury, in our initial costing estimate of the impact of Bill 41 on bodily injury loss cost, we expected a decrease to loss costs. What we saw in our prior review and what we're seeing in our current review is that our model is having a tough time breaking out some of the offsetting impacts or differing impacts that are happening all in this short time period. And so our model is suggesting a positive reform scalar. And so one of the things we do is we review the reasonableness of our model outputs. And when we look at what the reforms actually introduced, we didn't find that a positive impact to loss costs was reasonable as a reform estimate. So what we ended up deciding to select was a 0% reform scalar. Now, that's not to say we're saying there were no impacts in this period that increased loss cost, but just that the reforms were not able to explicitly split out, and so we select 0%. For accident benefits, we're starting to see a bit of stabilization in our estimate of the reform scalar. As we were coming out of the pandemic period, our estimates for the reform scalar on accident benefits was a little volatile, but in the prior review, we were at 11.6%. In the current review, our model suggests a 10% increase. Our initial assumption was an 8% increase. So we're back to about where we expected, and it's stabilizing around this 10 to 11% level. And then the last one was DCPD, which what we're seeing is that collision frequency following the introduction of DCPD is significantly down, and total property damage is about back to the pre-pandemic level. So we think there may be some shift of claims that's happening that's causing this phenomenon, but I'll go back into that in a couple slides. So these are bodily injury and accident benefits models. And I just want to focus to wrap up a couple things from Felix and Raj's section, which I will go back to one of Raj's slides. But there's a lot of factors that are affecting this 2021-2022 period. We have inflation, we have reforms, the end of the pandemic. And so there's these things that we need to split out. And again, in our model, we're indicating a positive reform scalar. To wrap up Felix and Raj's section, well, I will go back to this slide here. The development that Felix noted was down, and really where that shows up is in these factors, the inflation factors. The trend rate that Felix presented was 8.7% in our prior review, 8.8% in our current review. But this bodily injury column of inflation factors is where that really showed up. And I just wanted to tie that all together. And then you'll see for the accident benefits, specifically the severity, so that middle panel on the right side, in the 2020 period, we see a slight bump in severity, and then we're observing a slightly depressed trend rate following the introduction of Bill 41. So shifting over to the introduction of DCPD, we have this phenomena where we're seeing collision, which is this lighter gray line that was higher during or pre-pandemic and now is significantly down. And then if we look at property damage, we have this light blue line that's about back to pre-pandemic levels. And so to remove any of this shifting effect, we looked at, well, if we combine them, that removes it. And so that's the black line. And what we're seeing is that the combination is down from pre-pandemic levels, which is what we would expect if we look at some of the other coverages and also other provinces where we're seeing these hybrid work environments and different traffic patterns are resulting in a reduction in frequency following the pandemic. And so what we hypothesize may have happened is for both coverages, there's this pandemic effect where that decreased the frequency. And then there's this shifting that also happened, which decreased collision even more and then offset total property damage, which resulted in a factor back to pre-pandemic. And so what this all means for a rate indication is that there are these reforms in the pandemic that we need to adjust to get to where we think the future will be. Some of these periods are too low in the experience period, some are too high, and so we need to come up with factors to adjust them so that they can be used to estimate the future rate level. And so we do this through what we call combined new normal factors. And I'm going to walk through these 3 panels that we include in a section in our report just to show how we come up with our combined new normal factors. So in this first panel, we take, and this example will specifically apply to collision, but the methodology applies to all the coverages. So in that top panel, we have these black dots, which are just our raw observed frequency, ultimate frequency that we estimate. And so then we take the trend from our frequency model. So for collision, it's minus 1.3%. And we trend all of these points to a 2025-1 level, or trend them to 2025-1. And so then we get this light blue line, which we call our trended frequency. So then moving to the middle panel, we then have this trended frequency, which we fit a model to and get this smooth frequency. So try to remove any of these variations and look at what the modeled frequency is. And so that table to the right is the output from the coefficients from that model. And then in the bottom panel, we look at that smooth frequency. We apply the design matrix. So that's what the mobility parameter and new normal parameters. We apply that design matrix with the resulting output from the middle panel, and we get our smooth, we look at the smooth frequency and compare what that smooth frequency is to the 2025-1 level. And so then we get the adjustment factor, which is just the smooth frequency for the historical period divided by the smooth frequency for the final period. And so we try to include just a small example here of a pre-pandemic period, an in-pandemic period, and a post-pandemic period, and how we get to those adjustment factors. But in Appendix G in our report, there are more details on this calculation for all periods. And so then just looking quickly at our adjustment factors for a couple coverages. For bodily injury, what we're seeing is that the post-pandemic frequency is down from pre-pandemic. There are a couple in-pandemic periods that need to be increased to the post-pandemic period. And so we adjust those accordingly. For total property damage, as I mentioned earlier, we're seeing that the frequency is back to pre-pandemic. So we just have these couple in-pandemic periods that would need to be increased to the new frequency level. For accident benefits, the story is pretty much the same as bodily injury, although the decrease from pre-pandemic to post-pandemic isn't as large as it was for bodily injury. But then we, again, have those in-pandemic periods that need to be increased. And then for collision, as I mentioned, we have a much larger decrease to go from pre-pandemic to post-pandemic. And then there are some periods in pandemic that need to be increased slightly and some that need to be decreased slightly. But the main message here is the large drop from pre-pandemic for collision. And with that, I think that is our final slide. So we thank you for your attention, and we look forward to receiving any comments from industry on our report.